'Twas the night before US CPI and PPI, and all was well. We're saying that. We are seeing US equity markets grinding a little bit lower. We're seeing volatility fairly subdued. But can we kiss goodbye to all-time highs in the S&P and the Nasdaq as well? We're seeing commodities very much in focus as we see energy markets flying, specifically natural gas. And we're seeing gold finding few friends in this market, but can it last? We see the Australian dollar getting central focus from Blake and myself today. It's time to get in front of the charts. This is the trade-off. Well, hello, my name is Chris West. I'm head of research here at Pepperstone, and I'm going to be joined by my good friend Blake Morrow from Forex Analytics in 2 seconds. And we're going to be discussing all the market news, all the theories that are going on, all different setups and some of the trades that we like, and obviously breaking down the news and digesting it and seeing where the probabilities lie in this market. Mr. Blake Morrow, I'm going to bring you into the programme. Mr. Morrow, how are you going, my good friend? I want to point out two things. First of all, we've got this new lighting system in the studio here, and I think, unfortunately, you can see all the blemishes on my face. Second thing is that I think it does also make me much younger looking and youthful than previously, so that's a nice improvement. The other factor is that we were talking off air, and I just want to bring this to the viewers' attention, that Blake, and maybe most Americans out there, call penalties in football, soccer, PKs.
Yeah, PKs.
PKs. It's penalties.
Kicks, baby.
It's just penalties.
It's a PK. We know. Not you guys. We know.
No, you got knocked out the other day. It was an embarrassment, wasn't it? Awful.
It was quite embarrassing.
Is it? Moving on. Anyway, go on the Australians. Go on the English. Hopefully, we can make it through to next round. England beating Colombia in the Women's World Cup, taking it through to potentially play Australia in the round after that one. So that's going to be a edge of your seat moment to watch. And Blake, maybe you can wake up early and we can talk about that one next week as well. We'll see what happens. It's penalties, mate. It's penalties.
I'm going to watch the highlights.
It's penalties.
I'll be watching the highlights. Buddy.
It's penalties. It's not PKs. Come on, mate.
PK shootout. PK shootout.
Right.
Come on.
All right. Let's go into Topical Thunder. All right, equity moves. Let's bring in the equity mode. Let's start there because, I think this week or last week or the week before, we were talking about all-time highs, potential for all-time highs in the S&P, the Nasdaq. I think it's about 5% from those levels. Obviously, we've now seen the tail end of earnings season. I know we can still wait for Nvidia to come through at the back end of this month, and that may have some implications given its leadership in the Nasdaq. But I think the bulk of earnings are behind us. We're missing a bit of a catalyst, I suppose. But we've seen the S&P pull back a 3%. It's not a lot, but we've seen in that decline the VIX staying fairly firm around 16%. In fact, actually last night we saw the S&P drop 0.7% in the cash market, but yet still, the VIX actually fell as well, which is a weird dynamic to see. We're looking at those market internals that are playing through in the S&P. In that 3% decline, you've seen the number of stocks trading above their 20-day moving average dropping from 85% down to about 41%. So good participation on that drawdown that we've been seeing. And the number of companies at 4-week lows at the moment have gone up from about 0% to about 26%, quarter of the market trading at 4-week lows. So, market internals have shown good participation on this pullback. Where do you see the path now for these various global indices? I mean, I think for me, if we're looking at the US 500, the S&P 500, that 50-day moving average is something that we're looking at just a little bit lower than where we are at the moment, and that's defined the trend really for a number of months now. So I think that's been a good trend filter. I think below that level, and people might even start looking at selling rallies rather than buying dips. So that's a change of structure there. How are you seeing it, Blake?
I was just thinking, I don't know if we were actually taking a look at the S&P today, which is weird. Seems like we do, most weeks, especially weeks like this week where things look a little vulnerable. I brought a chart a long time ago. It was probably a couple months ago that we had to start watching the equal weighted S&P index, and that's called the RSP, I think is the ticker symbol. Anyway. It did break out. It was in a triangle, broke out, but it's actually retesting that. So that's something I'm watching. But, we've also been talking about some of the big names. I think last week we discussed Amazon, which Amazon beat and actually gapped higher. But the weeks before we talked about Microsoft and Apple. and I think Microsoft was a big one. Apple's actually rolled over. So some of the big generals are starting to get hit, and I think that's worth noting. Some of the big tech stocks are really starting to show some signs of weakness. So I'm still looking for distribution, and I think right now you're seeing money move from tech or big tech, and you're seeing it moving into some Dow components, maybe some stocks that actually yield some dividends. But I think we need to start being a little bit more careful here, especially that we're seeing the dollar perk up, and we're going to talk a lot about the dollar today because of everything else that's happening.
So where are you saying? Are we saying greater risks of lower levels, or do you think people are going to bounce back? Where's putting a gun to your head, Blake? Where do you see the market going? Where's the risk?
I think a little bit lower this month. On one of my videos that I did, I said, sell and may go away is actually still in effect, but it's sell in August go away, because if you're an asset manager, and this is very old school thinking, but a lot of the old school thinking would be, you sell in May, you go off for a few months, take off the summer, take your holiday, come back. And when you come back early September, the markets are usually a little bit lower than where you were in May. And I think that could actually play out this month, which means I think there's a little bit more downside this month. But remember, we're still in bullish territory. And I think even dips down to 4,200 in the S&P are buying opportunities.
Well, I put out. I was looking to buy into the 50-day in the US in the S&P 500 as a play of the day last week. We haven't got there, so haven't got the feel. I'm taking that off the table. I'm not caring. I think there's further downside here. CPI numbers we can talk and we will talk right now. But the big risk for me now is that Jackson Hole Symposium at the end of the month. I know we've still got a number of days until the end of the month, but I think the market's underpricing the risks of what we hear from Jerome Powell from that, and I think yield still could go a little bit higher, and I think that may permutate in lower levels. So I feel there's probably slightly greater downside risk. I don't see a collapse in equity markets, but I do see slightly lower levels as the base case at the moment.
Yeah, me too. And I think breakout levels are usually levels that get retested. The big breakout point was 4,200. I think we could realistically get down there. And I think you also bring up a great topic of our interim Fed meeting, which is Jackson Hole. Which let's turn it to our next topic, because CPI and PPI actually will matter this week, because it's really going to set the pace whether the markets believe the Fed is going to raise rates in September or not. I mean, that's really what it boils down to. I've talked to some traders. They're like, it doesn't matter. It's all priced in. No, it's not. I don't think it's priced in at all. And it's there are things that are priced in, but I think tomorrow's report and PPI the following day could really solidify the idea that the Fed will indeed raise rates in September, and probably give us a little bit more indication of whether the Fed's going to, continue to stay steady as well. Inflation, to me, I think one of the things that I've heard murmurings about, and I think we should at least note here, we could discuss it, but there's a feeling out there. There's a sense that a lot of central banks are not going to be targeting a 2%, inflation rate. Some central banks might settle for 2.5% or 2.4%, something a little higher. What are your thoughts about CPI going into tomorrow and producer prices, which it's been a 1-2 punch, Chris? If you look at the last several releases, it's like wham, you get hit one day, and then the next day you get PPI, or 2 days later, and it moves the market. What are your thoughts here going into tomorrow?
Well, I think one of the factors when Jerome Powell speaks at Jackson Hole at the end of the month is this idea about whether the real neutral rate is in the US, and it's more of an academic thing, but it probably some people are suggesting that it's way higher than where it is, and therefore, where they settle on policy longer term needs to be higher. But in terms of the actual inflation number, I would be looking at the month-for-month clip on core. I think that's really where we are. I know everyone's focused on the fact that the headline on a year-on-year basis is expected to push back up a little bit because of base effects and factors. But that's why we look at the month-for-month number now. And the market's looking for 0.2 of 1% on the core and actually the headline. So I think, where do the risks lie? I did see that one bank who canvassed their institutional clients said 75% of their respondents thought there was downside risks to that core inflation number below 0.2%. If we look at the various nowcast models, that you get from Cleveland Fed, for example. They've actually got 0.4%, which is way hotter, double what they're expecting there. It was pretty poor at predicting last one. But yeah, for the playbook, I'm looking on CPI and to an extent PPI. And again, yeah, that could be a really big input. Is 0.2% is what you're looking for. That's what the market's discounting. I think if you were to get a north of 0.3, certainly 0.4, the dollar's going to have a pretty good rally. You're going to see dollar yen breaking 144. Equities probably going under a little bit of pressure. Anyone who's telling you that September's priced in, well, we've got nothing priced. We've got about 3 basis points being priced for September. The market's saying it's not going to happen. So, yeah, maybe that becomes a little bit more live. But the November pricing for that is currently 36% chance of a hike there. That would probably move above 50% if we get above 0.4%, above 0.3%. If we get downside risks, obviously we might get the dollar down. Gold have a bit of a move, and maybe you get a bit more upside in equities. But I'd be looking at that month-for-month clip, and that's what I'll be focused on. Is that what you're looking at?
So any which way you slice it, the dollar, gold, everything's in play over the next 24, 48 hours. So you make sure you keep your head on a swivel, folks. Hey, I wanted to ask Chris before we move on. Didn't Pepperstone reach a huge milestone just recently on the YouTube channel?
Yeah, I was going to bring that up in the next one, but yeah, obviously, not obviously, in YouTube, we just got 100,000 viewers, so subscribers, sorry. So that's it's on a bit of a tear. So thank you for everyone who's been subscribing there, and I think also for people who are watching us on TradingView as well, because we stream it on that. We don't have 100,000 subscribers on that yet, so if you're looking at this, do subscribe to our channel going forward. That'd be obviously great to see, but. Look, I think we've seen some real interest in that, and I think hopefully this show is obviously resonating and some of the other stuff as well. So 100,000 subscribers on YouTube, it's good to go. So
huge number. Congratulations!
Thank you for everyone for following us on that channel. So hopefully we can keep pushing that on and hopefully deliver good content for viewers going forward as well. I want to bring it into the energy side of things. Blake, we've just seen crude prices trade to the highest level since November. We've been talking about nat gas for some time in terms of that setup. I've got a chart to show you later on. But yeah, we've seen a big bullish breakout in European natural gas prices. They're up 28%. US natural gas prices are just shy of $3. They're up nearly 7%. And for me, that's what we've seen is obviously the Russian gas has been turned, well, not completely turned off, but it's pulled right back and the flow into Europe. So supply is already pretty tight, but demand's obviously been whacked, certainly in Europe, because of the mild weather that we saw last winter. And now we're looking forward to the winter that could be in Europe and the UK and other places like that. And we're watching that. But what the new news is that we've seen these strikes playing out in Western Australia, these various different LNG facilities, Chevron and different facilities there, which probably equate to about 10% of global LNG production. And we don't know what those strikes are going to be like at the moment, how long they're going to go on for, if they go on at all. And the duration will matter. So you're basically taking 10% of production out for a period of time. And I think the market's sort of front running that now. So we've seen big volatility playing for energy markets. We haven't seen much buying of inflation expectations, but how are you trading? Are you seeing any kind of trades that you like? Are you trading it through the NOK, the Norwegian crown, for example? What are you seeing here?
Well, first of all, I got a lot to say about energy. Crude's breaking out. It's above $84, and it's trading above there, closed above there today. And I've actually been trading long the dollar Canadian, as I've explained here over the last 2 weeks. And I sold it beginning of the week. And I already reloaded a little bit lower, so I'm trading long again. And the one thing I need to point out is even though crude is trying to break out, it hasn't had much of an effect on the Canadian dollar, which is a divergence of that relationship, which is something that obviously if the dollar, if we have strong CPI tomorrow and it comes in a little hotter, that dollar Canadian should rip back up towards the weekly highs, which will be just around 135. That's how I'm playing it. I'm playing it for the fact that the Canadian dollar is just not participating. But there's another point I wanted to bring up with crude oil, nat gas, and everything else. You're taking a global economy that is being strained aggressively already by inflation, and inflation over the last year and a half, 2 years. And you've got stubbornly high energy costs, whether you're talking about driving, your fossil fuels, whether you're talking about heating your home. Just these costs are getting to a point where, when crude oil gets to these levels, it starts to become more of instead of rallying with risk, it becomes more of risk negative. So I think we finally hit that inflection point right around this $80, $84, somewhere around this level. I think if you start to see crude really rally and you start to see it trade up towards 85 to 90, I think stocks and risk in general are not going to like that.
I think you're right.
As a whole.
I like natural gas higher, but I think you make a good point, and that is that, when we were getting into $60, when oil prices were trading higher, actually we saw risk come into the market. Now I think there could be a tipping point. I don't think this is going to become a problem inflation until we get Brent crude and WTI crude above $100. I think we saw it some way, but I think the market's going to get a little bit nervous now that we've broken out. If we can sustain that breakout, we create a new trading range. Is this the point now where equity markets sell off because of that? That's an interesting dynamic, and we'll check the obviously price action will tell us a bit more about that.
All right, Chris, this is perfect. Let's talk about trading the summertime markets, the summer doldrums, if you will. And I thought we'd take this segment and really discuss it, because this is where experience actually matters. And we've been with you now. I think this might be our second summer, but typically around the months of July and August, people tend to take time away. I have a couple of my partners from Forex Analytics that happen to be off on holiday, and that's typical of this industry. So you have to employ different trading strategies during this time of the year. So I wanted to just take a moment, talk a little bit about it, and give you some expectations and maybe some tips and tricks that have really helped me as a trader over the years. So let's first and foremost, let's talk about patience. You have to be really patient in this market and in any market, but especially when you're trying to trade around the summers. This is where I like to employ what's called target trading. What I mean by that is, like, let's say I'm looking at a chart and I'm like, okay, look, if crude gets back to 80, that's an ascending trend line. I want to participate and be long if it dips back down to 80. If it never dips to 80, I'm not going to participate. But if it gets there, that's where I want to be long, because I plan the trade. I'm going to trade my plan. So I do a lot of target trading this time of year, not looking for massive amounts of volatility, but trying to imagine where I think things are going to go and just participate at those levels. Also, be cognizant of key events. I mean, you could take the whole week off and say, which I have a lot of traders that have. They're like, I'm just going to stick around, for CPI. I'm going to take the first couple of days off this week, come back for CPI, because that's where the volatility is going to happen. So if you kind of navigate around those key events, I think that helps. Also, lack of follow through. If you're trading this time of the year, don't expect the moves to be as big and broad. You get a little scalping, you make some money, take it and run. The follow through just most of the time is not there, because you just don't have the participation of the whole market. But those are some tips and tricks that I wanted to mention around summer trading. How about you, Chris? Is there anything that you'd like to share with the traders?
I think you made some great points, and thanks for Blake's school day, because there's some tidbits. I personally wouldn't be changing. I don't change my strategies. If I'm trading a momentum strategy, I'm not going to change it for market conditions. The strategy, is the strategy. But what you're talking about is quite different from what I would do in the market. I think the one thing that I took out, and I think is absolutely essential, is that patience situation. If I'm running a rules-based strategy on a momentum strategy, patience is dictated by the rules, right? You only trade when the setup's there, or the flow's there, or the move's there. And that's the same in all trading. And we take the Nat Gas move, which we'll talk about in a second. I mean, we've been waiting for ages for it to break out. If you had bought, you would have been subject to market moving lower. You just got to wait. You've got to wait for the market to reveal its hand, and I think that's a really, really clear situation. So, patience in trading is there. You've got to wait for the market to show, what this is the trade. It's the flow has suggested this is going to happen. And it's increased our probability of a further move. And I think that's a really excellent point. So some great comments there. And I think for anyone who's watching this and wants to understand a little bit more about target trading and what Blake's doing, do reach out to him and the guys at Forex Analytics to look at some of that stuff. So I think that's it's a really interesting way of thinking about how we're working the season. I don't adjust my strategies to these situations, but I'm sure a lot of people out there would say, that makes a lot of sense. And do reach out to Blake if that resonates with you. Anyway, let's go to the setups that matter. That's a setup. Right, first one I want to bring up, but it's going to be a bit of an Aussie dollar flavour. Is Euro Aussie. Now, we talk about patience, and this is another one that really goes at it because, obviously in FX markets, Blake, we're so used to sort of mean reverting moves. Mean reversion happens so much more in FX markets than we see in, say, agricultural commodities, even indices, for example. But what we're seeing now in Euro Aussie is this breakout. We've seen it testing that top end of the range, and it actually closed above that level. Now, I think from a fundamental perspective, you can talk about what's happened in the Australian economy, but you can also use the Australian dollar as a China proxy. We saw those awful trade numbers, both on an import basis and an export basis. Imports from the US from China is dropped 23% year on year, and the Australian dollar's been moving along. And I think dollar CNH continues to be a major driver of the Aussie dollar. But now we've got that close above there. The question is, can it kick on? Can it kick on, or are we going to get another failed breakout that we're so often seeing in FX markets? I think this is going to go long. Do I know it's going to kick on? Absolutely, of course I don't. But that's why so many of these fail, and then you cut out very quickly. But if it wants to kick up, you've got to be in that market. So can this kick up, Blake? That's why I'm asking you a question.
Well, I like it. I actually like the not only the Euro Aussie, I like the Sterling Aussie or the Pound Aussie. I like them both. But if you connect those lows just put a simple trend line across the lows, then you do it across the highs, you actually have an ascending channel, and so that actually suggests that we're going to go a lot higher in the Euro Aussie. Now, obviously, this is a risk on, risk off type of trade as well. So I think it's going to do better. Should stocks be a little weaker, you're going to see the Aussie dollar trade a little heavier than the euro. So, but if stocks bounce and we get a nice wicked bounce because we got a lower CPI tomorrow and producer prices come in a little weak. Hey, stocks will bounce and we might get that false breakout. So I think you got to follow the Euro Aussie, but you're right. You got to be on the lookout for a false break, and I think it's going to follow risk. So be watching risk as well.
I like it high, but you just got to cut that losses really, really quickly. Another one to look at, Aussie Swiss. It's been in a beautiful channel for some time now, and it's a nice segue. We'll take it in. Aussie Swiss, I think if that breaks down through 57.57, 0.57, then I think that's got a lot further downside. So Aussie Swiss has been a really good performer to the downside. I think that's another one you've got to have a look on there. But the Aussie looking pretty weak at the moment. I think China obviously the forefront there.
All right. Well, I'm gonna turn your attention over to my first setup, which would be the dollar Swiss or the Swissy. Now, I'm playing counter trend here, and I'm not long, so I just want to let you all know this is a setup. It's a pennant. And last week, I actually blogged about this, and I said I'm going to short it when it gets close to 88 cents. Got to 88 cents. I shorted it. I only made like 30 pips or something like that because I was just playing it back in the direction of the trend, letting it test the breakdown point. I traded it short, and it bounced right back. But notice how it's consolidating gains. And when you get a consolidation of gains, that means you're probably setting up in a bull flag, a bullish pennant like you see here. Which all we need, the final ingredient is we need some more dollar strength. That would be with a stronger CPI reading or a stronger producer prices reading, or even a stronger dollar reaction following the next couple of days data. I think if we break back above 88 cents or 88.20 rather, that'll actually take us to the channel resistance and then maybe even further than that. Yeah. So Chris, I like the dollar Swiss, and I'm leaning long, and it is a setup. What are your thoughts?
I like it because what you're doing is you're not trading ahead of the news. You're going to wait for the news to come through, and if we do get a hotter CPI number and the dollar reacts, we get front-end yields moving up. You've got a completion of the pattern, which is obviously what you want. So you've got the news coming through, which drives the completion of the pattern. If you get a weaker CPI number, then you're going to get it lower, and you haven't traded. So I think it's a nice trade. You wait for that. You react to the news. this goes higher if we get a hot CPI number and you've got a beautiful looking continuation pattern playing through. So I think it's a great trade, and we're just waiting for the facts to come through. We're going to react to the facts, and you've got that setup which shows a high probability into the top end of the channel. So obviously that's I really like this trade as well. But I do sit in the camp that if we were to, again, we come back to this fall every single time, and that is, ask yourself, do we get a bigger reaction in the US dollar on an above expectation CPI print, or do we get a bigger negative reaction on a below one? And I think that's the way to look at the risk in this situation. We're looking at positioning, market expectations around rates, and I think expectations are for a lower print. The market's short dollars, and I think from that perspective, the pain trade would be for a much higher. And I think, therefore, we get a bigger reaction to the upside in the US dollar on a beat or an upside surprise in CPI than if we were to get a lower CPI print and the reaction in the US dollar. I hope that makes sense. Does that resonate with you?
The pain trade is always the trade, and you're right. People right now are short of dollars. They're long. Still, you look at some of the positioning data, everybody's still short dollars, even after the euro's corrected 300 pips. So
one quick fact, and I'm going to bring it to a viewer client question: 137 basis points of cuts being priced in next year. It's staying there. It's staying there. The Fed can tell us they're not going to look to cut anytime soon, but the market still believes, and that could be, if we get a hot CPI number, something that the market looks at very closely. Anyway, last week what we did was we looked at we brought Blake and I bring a couple of charts out there, and we're going to throw this out to two viewer questions, two charts, and we've got one on the gold price there. So if we can bring that up, you can see Aussie Trader. G'day, Aussie Trader. And he writes, let's look at the best gold play. I'm just reading off the charts here, so you're watching my wandering eyes. What's the best gold setup considering a possible reversal in yields due to a clear credit squeeze, recession fears mounting, and US bonds becoming attractive again? Appreciate your weekly trade-off. Thank you very much, Aussie Trader. That's a great question. Now, I'm going to bring this up because what I've done, Blake, and this, I don't know if you've got any views on this as well, but I don't necessarily think that we're going to see a reversal in yields and maybe... and recession fears. But to answer the question, if we were to see that happen, I don't see that happening myself anytime soon. But if we were to see it happen, I think if we were to see rising recession fears and we were to see equity markets lower as a result of that, then I think the best play is going to be short Australian dollars. And I think if we were to see gold being a hedge against that recession risk, upside, then of course you want to be long gold in the weakest currency, which again continues to be the Australian dollars. So I think this would be the play for me to answer Aussie Trader's question. What's the best setup? What's the best trade for rising recession fear, lower yields, and to get into the gold price? For me, it would be long gold in Australian dollar terms. What do you think about that one?
First of all, I don't have anything to say about the gold in Australian terms. Gosh, that sounds like Dennis Gartman, like the old Dennis Gartman. You remember him?
I remember him. I want to do corn in the Sudanese.
I'm going to buy corn in Russian terms, in ruble terms. What? Anyway, but I will say this: both gold and Aussie is they're both trading really heavy right now, and I think you're right. If there are recession fears, gold should outpace the Aussie. That's just the way it should work, I would think.
Well, you just price it. If you want to go, if you can keep life real simple, which most of our clients do, and they just trade gold in US dollar terms, and it's just the default position, XAU USD, right? I mean, that's just it. But if you want to complicate things and go double bubble and get bang for your buck. Yeah, ideally, we offer gold in different currency terms, sterling, yen, euro, Swissy, a few other currencies. And so from a simplistic perspective, you buy gold in what you perceive to be the future weakest currency. And if you want to short gold, you can do it in what we consider to be the strongest currency. So that's where we are. If you like gold and you want to max out that effect in a recession, because gold works really well in a recession with rising chance of rate cuts, what is going to be the weakest currency for me, it would be the Australian dollar in that vein, because global growth slowing down. The US dollar should work quite well. So that's hopefully that answers the question. That would be the interest one there as well. So Blake, over to you, mate.
All right. Well, we got the next setup, and this actually comes from one of our other viewers, And Mike, thanks for writing this one or asking this one. Said, awesome show, guys. I think the Aussie yen could be a good one to play. Looks like we may see a brief drop below the 200-day moving average. Then it'll be interesting to see where the setup goes from there. So, I'm glad you brought the Aussie yen. And again, this is where, Chris, we're going to be a little bit more Aussie centric.
Yeah.
I think the Aussie yen is going to be a clear reflection of risk appetite or risk aversion following the next couple of days. How does the market respond? How does it take in this inflation data? Now, I think your eye is keen to notice the 200-day moving average, because a week and a half ago or 2 weeks ago, we spiked down there and we got a hell of a reaction from the 200 DMA, which is the bottom of this channel. You can see that bottom arrow. I think if we break back below the 200 DMA and we get a heavy close below that, it's going to trade lower. That means we probably are seeing stocks come under pressure as well. The flip side to that is if we get an Aussie yen rally towards the 50 DMA, which is my other moving average, which happens to also coincide with channel resistance, I think if it breaks that, you got a really nice bullish breakout. So that's how I'm looking at the Aussie yen, and it happens to be in the middle of the range. So I have no bias at this moment. But right. Chris, how are you seeing the Aussie yen right now?
Well, I think your no bias is the right one. So again, comes back to our idea about patience. Let the market push you into a trade and increase that probability within a distribution. And right now, that distribution is so normal in terms of it could go either way that you can't really, unless you're trading on lower time frames. This is one that just it could go up to the top of the channel. I'm a waiter. I think this is one you can have on the radar, wait for the market to come for you. I think if it breaks top side of that, what could really be just the mother of all bull flags there, then you've got huge upside. Obviously, downside, you've shown that 200-day moving average, you can see it through February, you can see it through May or April. It has been a level that the market's looked at pretty closely in terms of a trend filter, and we've been respecting that level again, so that has significance, but it also has the bottom of the channel. So really good setup from Mike in terms of where this can go. It's not something that's going to resolve itself overnight. It's going to take a while, but when it does, I think that could be very, very meaningful for a potential trend in the market, which of course I like. I love trends. I love the idea of latching onto one. So this is one that you just keep a cheeky beady eye on, unless your strategy is to sort of, you like that sort of choppy flow. And I think this is a great one. So thanks to Mike for bringing it, and Aussie Trader as well. And for anyone out there who has a setup that they like and want Blake and myself to look at it, but also to put out into the trading room, into the comments, and so for all of us to sort of give our own view, like work it in a kind of Discord kind of fashion in a way. Put your setups there. What do you want us to cover? And also give your own views, and maybe other people can comment on that as well. Let's go through these trades together and see what's on the radar there as well. Anyway, let's go to play of the day. Right, well, I'm bringing up the bad boy natural gas. You got to be a bit of a crazy cat to be trading that gas, because the vol is there, and you can have these big moves. So obviously, when you are trading these markets, do consider your leverage, do consider your risk management, how far you want to take on terms of risk and your stop loss, because these can have some punchy moves. Look, it comes down to my theory about breakouts. I know if you take that high-low to range that we've been seeing throughout the year, it's about 30-odd%. So it's a decent range. It looks cunningly like it's a tight range, but you've still got a decent percentage. But what we've seen is there has been this suppression of volatility. You can see the Bollinger Bands recently have been really, really tight. And because it's just been coiled for so long, when it does break out, it can be very, very powerful. So if you're a CTA fund at the moment, if you're a trend follower, you've got this on the radar. Trends start with breakouts. They always start with breakouts, whether you're using a Keltner band, a Bollinger Band, whatever, Donaldson channel, whatever you're using, it starts with a breakout. And you don't know if that breakout's is going to materialise. You have no idea. Of course you don't. But you're buying outliers within a distribution, and you need to be in it. And your job then is to hold. You need to hold that position, and that's where having a systematic or mechanical stop loss can be very, very helpful. This has had the breakout. It's trading above all these different factors. The short-term moving averages are moving up. Price is above there. It's done everything I want now. I'm going to be long this. It might fail, and often so many of these do fail, which is why in trend following you have such a low win-loss ratio. 30 to 40% is not uncommon. And this, but if it kicks, you've got to be in there. And so, I like this higher, and I want to be long this for higher levels. Of course, it comes down to the duration of strikes in Western Australia, I think, in the short term. But I want to be in this one. It's broken out. I want to be involved, and I think we go higher here.
What a pretty chart, Chris. It really is.
Thanks,
wow. Thanks for bringing that up. So my play of the day is actually going to be silver because I think it's a little tarnished here. Now, before you all get crazy and excited about silver, and some of you might get a little offended. Yeah, I am looking for a 10% decline from here for us eventually to go from $22 to 20. But let me tell you, I am a buyer on dips in precious metals. I do think that gold and silver are trading both heavy right now. As Chris mentioned, if we do get into a recession, precious metals are going to start to perform a little bit better.
It's not going to happen anytime soon,
I think is probably. Yeah, well, and it might be more of a risk of second half of this year. So in the meantime, we have snapped an ascending trend line. You can see we're below the 200-day moving average. That's that red moving average. And right now, the 161% extension takes us down to that red ascending trend line, which, by the way, it is the low from the post-COVID lockdown lows in 2020 to the lows in 2022. All come in right around $20. So if you're a silver bull or you're a precious metal bull, $20 might be a huge pivot level for you. And in the meantime, you gotta respect the fact that we're seeing a little bit of a bearish breakdown right now. Yeah. So I like silver short now, but $20 would be a place for longs.
Love this as well. Love it. I concur completely. I think this is further downside risk. We've got two pretty crazy high beta commodities there. Silver will have 4% move when gold has 1.5% move. So again, both of those, you need to understand the risk that's involved in these higher beta markets. Obviously consider that if you're trading on leverage. But I think that's a great trade. And I mean, go and look at gold at the moment in euro terms. It's down like 6 or 7 days in a row now. The markets are making lower lows. There's not a huge amount of buyers stepping into the gold markets and the silver markets there. But I think maybe that changes longer term. But right now, the short term, the flow is down. And I like that trade on the short side of silver as well. So we'll see where that goes. Anyway, thank you everyone for watching today. If you've watched this far, smack that like button. We really, really appreciate that. And the comments, leave us your charts for the days. We will look at those. We'll pick two of the better ones. And obviously, if people want to sort of comment on other people's charts, go nuts. We'd love to see that as well. Anyway, we'll see you next week for more of The Trade-Off.